In this presentation, we will take a look at an example problem recording transactions in the debt service fund and the general fund, as well as the government-wide activities. We're going to be focusing in on the debt service fund. As we focus in on the debt service fund, we will be talking about a capital project. We're not focusing in on the capital projects fund because we're focusing in on the debt service fund and the relationship to the general fund, as well as the government-wide activities. The government-wide activities being on the accrual basis, the debt service fund and the general fund being governmental funds are going to be on the modified accrual basis. Typically going to start out with the government-wide activity because that's going to be on the accrual basis, and then we'll think about the transaction from an accrual basis and how we can put it together on the fund side of things. We're going to have our trial balance on the right side as we go through these government-wide activities and the funds. That's going to be in order of assets in green, liabilities in orange, and then the light blue being equivalent to the equity section, the net position for the government-wide activities, the dark blue being equivalent to the income statement or temporary accounts, those accounts that would typically close out to what would be the equity section in a for-profit organization net position here in the government-wide activities. First item, we have the general fund collects and transfers tax to the debt service fund. So the general fund then is going to be collecting the taxes and then transfer it to the debt service fund. What's going to happen on the government-wide activities, when we think about everything, the company as a whole or the entity as a whole, we're going to record the collection of taxes. We're going to say that the revenue is going to go up as well as the cash. We're going to debit cash for the amount of the taxes. We're going to credit the general revenue account. So if we see that, we're going to say that the cash is going to be increasing. We're going to increase the cash, and then we're going to increase the general revenue account. Note what we don't have here is we don't have a transaction recording the transfer from one fund to the other, because that's going from one fund to the other and therefore is an inter-fund kind of transfer. We're not going to be recording on the government-wide type of activity because it's going between the two funds. Then we're going to say that amount used to retire outstanding serial bonds. We're still in the government-wide type of activities. We're going to use the amount to retire the serial bonds. We see them on the books at the $830,300. If we were to retire the serial bonds, we need to debit this amount then. So we're going to debit the serial bonds. We're going to credit the cash for $880,300. And the difference between the two is going to be the excess interest. It's going to be the interest for the serial bond. So paying off the serial bonds, we're going to have the serial bonds going off the books with a debit. Here they are on the books. We're going to debit them, bringing them down to zero. We have cash being credited. Here's cash. Going to credit cash, bringing it down. And then we're recording the interest expense down below. Here's the interest expense that will be recorded. This should look familiar on an accrual basis if we were to retire off, say, something like a bond, including the recording of the interest related to it. So now we're going to move over to the general fund. So now we're on the fund accounting side. We're in the general fund, and you'll recall that the general fund collected the taxes. So if we record the collection of the taxes in the general fund, the cash is going to go up as it did for the government-wide activities. The other side also going to revenue as it did for the government-wide activities, although the revenue account is not as long and detailed as in the government-wide activity. So we're going to say that the cash then is going to go up. We are increasing the cash. And then the other side is going to go down here to the revenue. So we're going to be crediting the revenue account. Next item is that we transfer the revenue from the general fund to the debt service fund, which we didn't record in the government-wide activities because it's going from one fund to the other. But within the general fund, of course, we would record it. We would say that the cash is going down. It's going out of the general fund. And then we're going to record the debit, which is kind of like an expense or acting similar to an expense, other financing uses. And that's going to be kind of the income statement type of account or temporary type of account that will be going up in the debit direction, similar to an expense would go up. So the general fund. So if we record this, then the cash is going to go back down. So we're going to reduce the cash. And then the other side is going to go to the other financing uses. Other financing uses is going to go up in a similar fashion as an expense would, although it's not going to be an expense or an expenditure, but it's going to be acting in that fashion, bringing down what would be similar to net income in a for-profit organization. Now we'll move over to the debt service fund. So now we're in the debt service fund. We're considering the same transactions here. What happens in the debt service fund? Well, we had a transfer from the general fund to the debt service fund. So now we're going to have to record that inter-fund transfer against something that wasn't recorded in the government-wide activities, was recorded in the general fund as the money going out, now being recorded in the debt service fund as money going in. So we're going to say that we got cash then is going to be the debit, increase in the cash. Other side going to other financing sources, an account acting similar to a revenue type of account. It's going to be another type of, it's not exactly revenue, but it's going to be increasing in a similar fashion as a revenue would in the temporary type of accounts. So we're going to say cash, if we post this out to the debt service fund, is increasing. So we have the increase to cash, the other side going to other financing sources. We have the inter-fund transfer in a credit direction, going up in the credit direction as would happen for a revenue type of account. Now we're still in the debt service fund. We're going to record the second piece that happened, and that was the amount to retire the serial bonds. So of course we're going to credit the same amount for the cash that was used to retire the serial bonds. And this is going to be the same for the government-wide activity. We credited on an accrual basis the $880,000 to retire the serial bonds. The debit, however, is not going to be debiting or reducing a bonds payable account because we're on the modified accrual basis. We don't have the bonds payable here in the debt service fund. We're tracking the activity of the financing of the debt, and therefore we're going to put it into the expenditures amount. So it's actually going to be recorded down here in what would be similar to income statement accounts, temporary accounts, accounts that close out into the expenditures type of account. Then the other side on the expenditure for interest, also looking similar to the government-wide activities, because on the government-wide activities, we recorded the expense on an accrual basis as an expense. Here, we're going to be recording it in the activity section as well as an expenditure. If we record this out, then we're going to say that the expenditures for the principal is here. So we're going to say expenditures for the principal is going up. That's the unusual piece right here, because you would think that we would be putting that to a liability on an accrual basis. However, we don't have the liability, of course, because we're on the modified accrual basis showing the activity. We have the cash going down. Cash is up here. It goes down to zero. Then the difference going to the expenditure. So we have the expenditure increasing in the debit direction for the $50,000 of expenditure for the interest. Next item, we're going to say that we issued serial bonds to finance a capital project. So we're going to start a capital project, long-term project, to build a building, a bridge or something like that, a road that we're going to build, and we're going to issue serial bonds in order to finance it. So the face amount of the serial bonds is going to be this $8,807,000. Then we're going to issue it at 102, meaning we're going to issue it at a premium. Plus we had accrued interest that we're going to have to put on the books as well. So if we record this out, then we're going to say that the serial bonds under an accrual basis, we're on the government-wide activities, serial bonds going on the books for the face amount, $8,807,000. We've got the accrued interest, or the interest payable then, going on the books at $88,500. Then we have the premium, and we can calculate the premium as the face amount of the bond, $8,807,000 times 1.02. And that's going to be this amount minus the face amount, which is the $8,807. And that's going to give us the amount of the premium that we have. And then the cash that we're going to receive is going to be the $8,807,000 plus the $88,500 plus the $176,140. And that's going to be the cash, the $9,071,640. So if we record this out, this should look fairly similar to recording a bond. This is on the accrual method. We're going to say that the cash is going to be going up. We have the increase in the cash for the bond. We have the serial bond payable going up in the credit direction. We have the interest payable, then a liability account, and of course the premium then also going up in the credit direction. Now we want to take this and consider what's going to happen on the fund accounting side. So if we think about this in the fund accounting, it's going to be on the modified accrual basis. We're going to be working with a debt service fund. What's it going to look like in the debt service fund? Once we've constructed the journal entry in the government-wide activities, we want to take it apart and say, what's it going to look like in the funds, in the fund accounting? So we're going to be concentrating on the debt service fund. Note that this was going to be a bond that was issued for a capital project, so it would affect the capital projects fund, or could affect the capital projects fund as well. We're not going to be focusing in on the capital projects fund, but the debt service fund. Within the debt service fund and the capital projects, them both being governmental funds, we're not going to have the serial bonds payable because it's going to be a long-term liability, something that's not on the modified accrual, therefore not on the debt service or capital project type of fund. Within the debt service fund, we're talking about the items that are going to be servicing the debt and the flow of the service of the debt. So we're concentrated here on the interest payable and the premium on the bonds payable. And of course, the cash that's going to be related to it. So when we think about this transaction, there's going to be a part that's going to go to the capital project related to the financing of the capital project. That typically going on the books for what is lower, either the face amount of the bond or the amount of cash that was received. In this case, the face amount of the bond because we issued it at a premium. Debt service fund. Then we're thinking about the servicing of the debt, the amount related to the interest of the bond. So we're considering the interest payable and the premium on the bonds, and then the cash related to them. So in the debt service fund, we're going to have a debit to cash, the $264,640, and then we're going to credit the $176,140. That's the premium amount that we saw here in the government-wide activity. We're not going to record it in a premium because that's going to be related to a long-term liability. We're going to record it into other financing sources. And then the other side is going to be the revenue. That's for the interest. So this is going to be our transaction in the debt service fund. If we record that out, we're going to say cash is going to go up from zero, debit direction, the $264,640. Then we're going to credit the other financing sources. Other financing sources, we have the premium on the bonds payable, that increasing, and then we have the revenues up top, revenue going up top at the $88,500. This will look a little bit funny, of course, because again, we're talking about the bonds and the financing of the bonds, but we're tracking the financing portion of the bonds, and we're recording those down here in the temporary kind of accounts that would flow out or close out to the fund balance, equivalent to retained earnings or equivalent to the equity section of a for-profit organization. Back to the government-wide activity. Next item says that the debt service fund makes a lease payment, and the funds used to make the lease payment came from the capital grant received from the special revenue fund. So we got a grant received from the special revenue fund. We're going to record that first. That went to the debt service fund. The debt service fund then using that to pay for a lease payment. So first we're going to record the grant. We're in the government-wide activities. So within the government-wide activities, we're going to debit cash. We're going to credit program revenues from the general government. So this is going to be in the government-wide type of activity. So we're going to say then that cash is going to be increasing. Cash goes up in the debit direction. The other side then going to the program revenues. So we're down here in the dark blue area, program revenues going up in the credit direction. That then putting us back in balance. Then the second piece of it is that we're spending cash in order to pay off the lease obligation. So cash is going to be going down by the 131. We're going to say that part of it was related to interest. So when we think about this lease, we're saying it's a lease obligation. We're basically treating it as a capital lease. You'll note that we're paying cash. We're recording interest on it rather than just recording a lease expense. And then we have the lease obligation payable on the books. It's on the books as a liability. We are decreasing it. So we're basically treating this lease in essence like a capital lease. It's on the books as a liability. We're recording and have imputed the interest related to it. And we're making the payment, recording something that we would in a similar fashion as if we were paying off a loan payment, crediting the cash, debiting the payable. So if we record this out, then we're going to say that the lease obligation payable is here. It has a credit balance. It's going down. So we're decreasing the lease obligation payable. We've got the expenses. So the expenses for we'll note that the interest is going then we have the interest of the 18. That's going to be increasing the amount of interest. And then we have the cash going down for the lease payment. Now we want to consider this and say, well, what's going to happen on the fund accounting side of things? So we're still going to be recording this in the debt service fund. However, we're not going to be recording the lease obligation payable because that's going to be a long-term type of liability, but instead going to have to put that somewhere else. It's probably going to be an expenditure type of account in the modified accrual basis. Let's see what that will look like. We're going to go to the debt service fund. We're first going to record the grant that was received. So cash is going up just as it would in the government-wide activities. The other side then going to kind of like a revenue type account, this would be the other financing sources. This is the interfund transfer in. So interfund transfer in, we're going to say that cash then increasing. We have the debit to cash. It goes up in the debit direction. Other side going to other financing sources, going to act like a revenue type account, has a credit going up in the credit direction. Then we're going to use that. We use that to pay off the lease. So the cash is going to be going down. The debit, however, not going to the lease obligation as we saw in the government-wide activity, but going to expenditure. So we're just going to break out the expenditures between the principal and the interest. So this is going to be the funny part. The principal here being recorded to what would be kind of like an income statement account, a temporary account, one that would close out as we're on the modified accrual basis as opposed to the normal accrual basis. If we were to record this, then we're going to say that we're going to debit the expenditure for the principal. So it goes up in the debit direction. We're going to debit the expenditure for the interest. It goes up in the debit direction. The other side then going to cash, cash going down. It has a debit balance. We are decreasing it. Cash then going down. Back to the government-wide activities, next transaction. We then have the serial bonds issued to permit funding of the term bonds. So we're going to issue the serial bonds. In other words, we're going to get the cash related to the serial bonds, and we're going to pay off the term bonds, which are on the books here. So we're going to take this money from the serial bonds and pay off at least part of the term bonds. So we're going to then record cash is increasing for the serial bonds, and we have the credit then going to a bond payable, kind of a liability type of account, as we would expect. We're in essence recording a payable. We're getting cash, recording a payable. If we record this out, we're going to say cash then debit. Cash has a debit balance. We're increasing it in the debit direction. Then the other side is going to go to the serial bonds payable. Here's the bonds payable. It's going up in the credit direction to the total credit balance here. So that's our first transaction. Then we're going to take that money. We're going to use it in order to pay off the term bonds. So now cash is going to go down, and we're going to pay off these term bonds. So at least part of them. Here's the term bonds. We're going to pay off the term bonds. So there we have that. If we record this, then we're going to be crediting cash. Here's cash. It's going to go down in the credit direction to here. Then we have the term bonds. They're on the books with a credit. We're going to debit them, decreasing the amount of the term bonds. What's this going to look like in the fund accounting side of things? We're going to go to the debt service fund, and we're going to have the same kind of process. However, of course, in the first journal entry, we're not going to have the serial bonds because they're not on the books under the debt service fund because it's fund accounting modified accrual. So we're going to have to do something other than record it to that liability. And here, we're not going to have the term bonds that we're going to pay off because that's a long-term liability. It's not going to be on the modified accrual basis. So that's going to look slightly different in the modified accrual as well. Let's see what it'll look like. We're going to, for the first transaction, we're going to debit the cash as we did in the government-wide, but the other side going to other financing sources, proceeds of refunding the bond, which is going to be kind of like a temporary account, an income statement type account. A revenue type of account, which should look kind of unusual, but again, we're tracking the flow here as opposed to a full accrual basis. So if we then record that out, we're going to say that we have the cash up top, cash is going up, and then the other side going to other financing sources going from zero up in the credit direction. Next item is that we then use that to pay off the term bonds. So now we're going to say that the cash is going down. We're paying off the term bonds, which we're going to record to other financing uses. Again, should look a little unusual for an accrual basis. We're not paying off a liability. We're not debiting a liability. We're not decreasing the liability, but instead putting it on the books as other financing uses, kind of like acting like an expense type of account. So if we record this, then we've got the other financing uses. That's going to be going up in the debit direction. The other side then going to cash. Here's cash. And it's going down with a credit to the debt service fund.